Okay, here we are at the shutdown point. The rule on shutdown reads this: if the average variable cost is greater than or equal to the price or marginal revenue, however it's listed, this is an either or, you should shut down. And I'll give you the reason for this. Average variable cost is basically the cost per unit of production. Okay? Our price or our marginal revenue is basically how much we can sell it for. Revenue per unit. If it costs me more to produce it than I can sell it for, stop. I'm just digging a deeper hole at that point. However, if I can sell it for more than it takes to produce it, I'm still making a profit. The shutdown point comes into factor because these companies have fixed costs. Did you ever wonder why a company that is losing $1 million stays open? It may be because that $1 million is tied up here in fixed costs. The way to look at the shutdown point is that there's a person down here in a hole. The person's in a hole, and that's because these fixed costs already exist. The idea here is, if I can get more per unit, my price or marginal revenue is greater than ABC, I should stay open. What I'm doing then is actually filling in my hole, making it a little less deep. Sometimes maximizing profits actually means minimizing your losses. That's a good thing. However, if it costs me more per unit to make it than I can sell it for, all I've done then is gotten out my little shovel and I'm digging a deeper hole. I should shut down then and quit. That is what the shutdown point is. If ABC is less than these, stay open. If ABC is greater, shut down. That's how you determine that. Now, between the shutdown rule and the production maximizing rule, you should be able to look at a string of numbers, such as this. ATC, say, is $100,000. AFC is equal to 90,000. ABC is equal to 10,000. Marginal revenue is equal to 5,000. And marginal cost is equal to 4,000. I could be able to give you a string of numbers like that, and you should be able to look at this and immediately tell me what that company needs to do. And it comes in two steps. The first step is a comparison of ABC and MR. In this case, ABC's $10,000. It cost me $10,000 per unit to make it. I can only sell it for $5,000. That should be a real easy answer for you. You shut down that company. Shut down immediately. But let's change a number here. Let's say this is $15,000. That brings up B, C, and D, which is stay open. Stay open in each one of these. And then we have an increased production, decreased production, or maintain. Here, we've passed the first hurdle, which is the shutdown point. Now, for number 2 comparison, we look at the MR and the MC. In this case, MR is far greater than MC. MR is greater than MC, what do? You increase production. It's right here. We would stay open and increase our production. But let's say, for instance, that MC was 24. MC is greater now. In this instance, we need to decrease production. But this is how to use those rules to make decisions that affect your company. One more thing in this chapter of great importance we need to get clarification on. And it comes with the definition of costs. Fixed costs are costs that do not vary with production. Variable costs are costs that vary with production. What kind of cost is a marginal cost? Think about that for a minute. Is marginal cost fixed? Does it stay the same all the time? No. Therefore, marginal cost must be a variable cost. What we're looking here, as we do analysis of situations that happen, first thing I've got to be able to determine is if the cost changes are fixed or are they variable. For instance, if fertilizer goes on sale tomorrow, is fertilizer a fixed cost or a variable cost? Typically, we would look at that as a variable cost. If I've got a situation where I'm producing at a level that MR equals MC, and VC, a variable cost, increases, I know that my marginal cost will also increase. If that happens, what should I do in return? That's where I alter my production. I would have to reduce production in that instance to get them back into balance. If my variable cost goes up, raising marginal costs, I decrease. If my variable costs go down, like my fertilizer on sale, my marginal cost went down. I can actually increase production then. So that's what we got to look at. If, however, something like property taxes change, does that affect production? No, because it's a fixed cost. Doesn't enter into this at all. So that's something we need to keep in mind. You've got to know the relationships of all those things we've laid out there as we make these analyses. And finally, don't forget the long run. In the long run, there's only one decision that is made, and that is the investment decision. The investment decision treats all costs as variable because nothing has been purchased. There are no fixed costs. As soon as the first thing is purchased, we've moved from the long run to the short run, and we have fixed costs at that point. Once we have those fixed costs, then we've got to start doing these analyses. And in the short run, where there are fixed costs, there are two decisions to make. Production decision, shutdown decision. You've got to be very careful of that. Now, remember this, that there are fixed costs in the short run. Variable costs will vary with production. One way to think about this is if I produce zero output, will I still have things I have to pay for? If you do, those are fixed costs. At zero production, total cost is actually equivalent to fixed costs. So know these relationships. That's the important part. As you go through these 3 chapters, there's a lot of information and it tends to be kind of dispersed. Take your time, sort through it, read carefully. And if you have questions, please let me know. I'd be happy to help you. Thank you very much.